You can see in the late 90s how productivity moved from very low levels. It had been stuck in the 1 to 2% range on average for a very long time, and it moved up during that tech and telecom period, tech and telecom bubble. It ended in the bubble. It went into overdrive and too much investment too soon when the costs and the technologies weren't ready. Well, we're ready now. And we're almost at the productivity levels that were in place back then. And we're at just the beginning of the AI revolution that is catalyzing changes in all sectors.
Quite a number of predictions and projections have been made about the global economy going into the 2030s, some gloomy, others optimistic, all interesting. For Cathie Wood, renowned hedge fund manager and the founder, CIO and CEO of ARK Invest, the megatrend to look forward to in the coming years is the transformative and explosive powers of disruptive technologies. Cathie believes the world is on the brink of the most explosive period of growth in human history, with the convergence of artificial intelligence, blockchain technology, robotics, genomic sequencing, and energy storage expected to rapidly redefine industries, create untold opportunities, and drive unparalleled economic expansion. Cathie emphasizes that these innovation platforms are not isolated phenomena, but are interdependent forces converging to reshape the economic landscape. Drawing parallels to the Industrial Revolution brought by the telephone, electricity, and internal combustion engine, she argues that this new era of innovation could yield even more profound economic and societal shifts. She also compares the coming disruptive technology revolution to the tech and telecom bubble, but draws an important distinction. This time, the world is ready for the explosive multi-trillion-dollar growth that will accompany this revolution, without causing another massive bubble burst. In the latest episode of her monthly In the Know podcast, the ARK Invest CEO gives a much-needed update on the U.S. economy, talking through recent economic data, federal budget deficit, real GDP, and productivity. In previous updates about the U.S. economy, Cathie had shared believes that the U.S. economy was heading for a recession or already in one. However, in her latest update, Cathie explains that there is a chance that we have narrowly avoided a recession. She also discusses some mixed signals in recent economic data and what they mean for the economy going forward. As we bring you clips from her video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for the support and enjoy the video.
Well, we got the employment report today, Employment Friday, and something for everyone, but by and large, a strong report. I mean, manufacturing jobs were down, but the headline number was much stronger than expected at around 256,000, with just small downward revisions. Average hourly earnings looked fine. In fact, there was a little bit of a milestone there, 0.3% month to month, but on a year-over-year basis, we finally broke below 4%. Now, we'll get to this in the charts in a minute. If productivity is actually 2% or more, that lower than 4% on the average hourly earnings would suggest that underlying inflation or unit labor costs are below 2%. So the Fed's very focused on labor costs. Productivity is a big part of that. Hours worked pretty flat, but by and large, a strong report suggesting that income growth will continue. Now, throughout the month, there were puts and takes. For example, the claims and the employment report I just mentioned and job openings, those all have been better than expected. But the quit rate has come down. The quit rate is really as low as it usually gets as we're entering a recession. People do not quit if they do not believe they can find a better paying job elsewhere. So that's an interesting juxtaposition, as is retail, or as are retail sales and consumption broadly, better than expected, but we have production weaker than expected. And probably one of the most surprising numbers I've seen recently is an outright contraction in credit card debt for the month. That's unusual as well. There may be some kind of anomaly, but thought that was interesting. The other thing is employment being strong as it is, and yet productivity also being strong. So that's interesting. If you think about economic growth, what is it? It's usually, if you think about GDP, it's growth of employment plus productivity is basically how you can sum it up from a high level. And both seem to be pretty strong. So why has there been such consternation? If you look at the sentiment indices, certainly last year they were terrible for most of the year for small business, for lower and middle income earners. That sentiment did start to pick up after the election, but in recent days, we just, on Employment Friday, got the consumer sentiment measures, and they've slipped a bit here. And I think what is happening is the euphoria after the election has drifted into uncertainty about what's ahead now that the transition is in place, and we're hearing a lot of talk about cutbacks in government spending. Those are jobs for some people, at least, and tariffs. That's an inflation fear, and that came through loud and clear, as I'll show you in the charts in a minute. There's a great fear that inflation is going to go through a resurgence here, and certainly that's what the headlines are blaring as commentators talk about tariffs and the saber rattling around them. So what I'd like to do now is go into the charts. As I mentioned, we're seeing mixed and some conflicting evidence. By and large, headline numbers will continue to move forward, but when you look underneath the headline numbers, there are some contradictions, and I think the uncertainty is picking up here. Just to give you a sense of that, as we've listened to various forecasters at the start of the year, you've got some saying that we are entering into a very strong recovery where inflation and interest rates will pick up significantly. So that's one point of view. We have another point of view, which is that deregulation and tax cuts will be a high priority and will dominate tariffs and immigration reform, which will be very good for the markets. But even there's a little uncertainty. And then we have another forecast group, and we respect all of these, by the way, coming out and saying, okay, we're going into a recession. In fact, we may already be in one because permanent job losses have been picking up really for almost 2 years now. And that particular team thinks inflation and interest rates will surprise on the low side of expectations.
Several prominent billionaires have recently expressed concerns about the U.S. economy, indicating that it may still face significant challenges. Ken Griffin, founder of Citadel, has advised against tax cuts due to the high national debt and emphasized the importance of allowing ambitious immigrants into the U.S. to bolster the economy. He warned that drastic deportation of non-citizens could lead to inflation and economic disruption. Warren Buffett, CEO of Berkshire Hathaway, has historically been cautious about the U.S. economy during periods of uncertainty. In the past, he has highlighted the unpredictability of markets and the potential for economic downturns, advising investors to be prudent. Jamie Dimon, chairman and CEO of JP Morgan Chase, has commented on income inequality and its implications for the U.S. economy. He has acknowledged that the economy has fallen off a cliff during downturns and emphasized the need for policies that address economic disparities. These insights reflect a cautious outlook among some of the nation's wealthiest individuals, suggesting that while there may be signs of recovery, underlying issues still pose risks to the U.S. economy. Cathie shares some of these concerns as well, but she is optimistic that President-elect Donald Trump's pro-deregulation policies will spur productivity and lead to explosive growth in multiple sectors. Here is another clip from her video.
Here you see, again, we're featuring this regularly since the bond market is so worried about it. The deficit as a percent of GDP is still in that 6 to 7% range, in the middle of what's supposed to be a decent recovery. I believe that if President-elect Trump and Elon Musk and Vivek Ramaswamy are successful, that this is going to reverse. And that will be a very good thing. Why? Government spending, as I've mentioned here before, is taxation. If not now, then in the future, or in the form of inflation, which eats away at debt. And that's just bad news for the markets. We believe that there will be more efficiencies introduced to the government sector, and we'll be very interested to see how many people in the government sector accept whatever terms that this administration offers. I don't know if still being planned is, are two things. One, 2 years of income and training to move into the private sector. We'll see if that happens, but if it does, I do believe that productivity will continue to go up quite significantly and maybe surprise significantly on the high side of expectations as technology becomes more and more, technology improvements become more and more a part of what defines this administration, certainly when it comes to the government sector. I wanted to show on this next page, Nancy Lazar at Piper Sandler's actually plucked this chart from the source you see below. And the point it's making is GDP can respond to austerity in different ways, depending on what the austerity is. If the austerity is tax increases, you can see how much more severe the response is than if the austerity is in terms of spending cuts and increased productivity. There's hardly any change in GDP with the latter, whereas the former, tax austerity, typically hits the economy pretty hard. We do believe that this administration understands that, and we do believe that that we'll probably see tax cuts and deregulation as the efficiency moves are announced. So one will be countering the other. Here's a chart of productivity. We take it back to 1990 to show you that productivity gains are, if you look in the context of history, in the middle to the higher end of this range. So that's the green. The green is labor productivity. The purple is GDP growth. If we are right, and technology, especially AI, is a huge catalyst for change and productivity in all sectors, not just the government sector. We believe productivity will move up to the very high end of this range, 5% or higher, which is very unusual. It usually happens sporadically coming out of or entering a recession or coming out of a recession. But the surprise this time is that it could be sustained. And that is a very, very healthy way to get economic growth. Productivity, corporations can turn productivity around in any of a number of ways. One is to pay labor more. So if you're not hiring as many people, but your existing employees are taking on more responsibility, wages can go up. Another impact can be higher margins. Another is more spending on R&D and capital spending generally. And then the fourth is lower prices. So we do believe that competition will heat up as deregulation evolves. A lot of regulations today protect entrenched industries, and we think that's going to change. So the combination of that deregulation and technology gains that drive productivity, we think are going to become quite significant. You can see in the late 90s how productivity moved from very low levels. It had been stuck in the 1% to 2% range on average for a very long time. And it moved up during that tech and telecom period, tech and telecom bubble. It ended in the bubble. It went into overdrive and too much investment too soon when the costs and the technologies weren't ready. Well, we're ready now. And we're almost at the productivity levels that were in place back then. And we're at just the beginning of the AI revolution that is catalyzing changes in all sectors and is working to accelerate other technologies as well, especially robotics.
The latest earnings reports from America's major banks, including J.P. Morgan Chase, Goldman Sachs, and Wells Fargo, showcase strong performances, reflecting optimism about the U.S. economy as Donald Trump prepares to take office once again. Bank executives expressed broad confidence in the country's economic trajectory, citing positive trends in M&A activity, consumer spending, and corporate optimism under the anticipated pro-growth policies of the incoming administration. However, these sentiments came with a mix of caution. J.P. Morgan CEO Jamie Dimon highlighted the healthy state of the U.S. economy, pointing to low unemployment and robust end-of-year consumer spending. Dimon welcomed the administration's growth-oriented agenda, but flagged potential risks, including inflationary pressures and escalating geopolitical tensions, as factors that could temper the optimism. Goldman Sachs CEO David Solomon also struck a hopeful tone, pointing to an improving operating backdrop and growing confidence among corporate leaders. In a press release, he emphasized the benefits of a lighter regulatory touch expected under the new administration. However, Solomon acknowledged lingering uncertainties surrounding trade, immigration, and broader policy directions that could create turbulence in the near term. These mixed remarks underline a cautious optimism as the financial sector adapts to shifting economic and political landscapes. While the banks celebrate their strong earnings, their leaders remain watchful of inflationary risks and geopolitical dynamics that could shape the future operating environment. As the Trump administration gears up, the balance between opportunity and uncertainty will likely define the months ahead for Wall Street and the broader U.S. economy. Do you agree with these largely positive sentiments about the U.S. economy under the Donald Trump administration? Please share your thoughts, comments, and observations in the comments section below. If you've enjoyed this content and want to see more, hit that like button. It really helps the channel grow and reach more amazing people like you. And don't forget to subscribe and turn on the notification bell so you never miss an update. Your support means the world to us, and it keeps us motivated to bring you more exciting content. Let's grow this community together. Thank you for being part of the journey.